Good afternoon, gentlemen. How are you?
I'm doing well, Matt.
Doing real well.
Good. Okay, folks, we're joined today by David Cates at Denison Mines and also John Cash at UR Energy. We're going to talk a little bit about the uranium macro today. A lot going on, and guys will also give us an update on where they are with their businesses. We better kick off in Niger. David, what's happening over there? I mean, on top of Russia, Ukraine, what's this going to mean for the market?
Well, Matt, it's a pretty live situation, so I'm always a little bit cautious on commenting too much on it, but certainly reminding us that the market has to process that certain jurisdictions have different kind of risks. And look, the reality is that this is not a new thing. In mining, geopolitics have always been an issue because the resources are in the ground in a place. And, I think in a way, we've almost become a little bit complacent in our industry until sort of more recent events in the last 2 years around where the resources are. But it's always been an issue because you always have the types of risks around nationalization, war, or in this case, changing leadership that's maybe unexpected. So it's not new, but I think it is really notable because right now we have so many future customers and utilities already realigning their supplies with Russia. And one of the places they might have been looking to shore up some of that supply would be a country like Niger. And, here we have, a possible government change and even announcements, and, I don't know how confirmed these are around supply of uranium out in Niger being restricted to Western countries. I mean, that's all the stuff that a customer does not want to hear when they're thinking about how their maybe new contract with a developer in Niger might be helping manage their Russia risk. So it's really a really negative situation from a customer standpoint.
It is a negative situation. I don't mean to belittle it in any way, but there have been sort of 80 coups since the start of this century in Africa. Usually peaceful transitions. This one seems to have a slight edge to it in the sense that there's the kind of Russia factor involved as well. I mean, John, you're down there in the US. You're kind of quite close to some of the politics down there. I mean, what's the reaction been as far as you're concerned with whether it be US customers in the shape of the utilities or even government?
A bit guarded, like Dave said, a bit of wait and see. We'll see what happens here. We'll see how France gets involved if they do, or if not. We'll see how the Russians get involved with the Wagner group. There are lots of photographs online right now of people carrying Russian flags. I don't know how sincere that is, how much of it's planted. I go back to the movie from a few years ago, Wag the Dog, where you don't know what's true and what's not. And I think this is a prime example, but we'll see what happens in the coming days. There are only 15 countries around the world that produce uranium at any economies of scale, and Niger is one of them, about 4 or 5% of global supply. It doesn't sound like a lot, but when you start to take a look at the Western supply versus Eastern supply, about 70% of world production comes from countries that are aligned with the East, not the West. And by my unscientific math, about 80% of consumption is Western, not Eastern. So there's a real dichotomy there that we've got to recognize and deal with. And just as utilities are trying to move away from Eastern supply, something like this happens, and it just throws more uncertainty into the market. So we'll have to wait and see how things play out.
Well, and Matt, the thing is, like, none of us wants to see this work out negatively. None of us wants to see our customers get jammed up with, instability in Niger. But it's hard to undo the anxiety and the risk that comes from this type of situation. And it does take us back to some of the first principles of mining around geopolitics and risk. And it's part of why our company is focused in Canada. I mean, we've had international assets. We've been, operating in places like Mongolia and Africa and in the United States. And we think North America is a great place to be mining uranium. You might not love your government all the time, but the environment is stable. We're not generally expecting any of the kind of risks that you'd see out of West Africa, whether it be in Niger or other countries. And those are the kind of things that customers just have to keep in mind. But it's not the kind of thing that we want to occur. I mean, this could be very negative for the customers, and hopefully it does work out peacefully, and hopefully the companies that have projects there are able to navigate it successfully. It's not good for any of us really to have this happen, but I just think it's a really hard thing for the customer to like take out of their mind and not have on the whiteboard of risks the way that they must today. They can't rub it off, however this works out. They can't rub off the risk of some of this when they're building their portfolios of product that they're going to expect to buy.
Well, absolutely. I mean, it represents whatever 5% of the market, which doesn't sound like a lot, but I think if inflation at 5% felt painful, not as painful as it does now, but it is significant move, and that kind of leads that perpetuates that conversation about East versus West, as you said, Sean, with regards to certainly around pricing, supply. Demand out of China, I think could usurp the rest of the market if not careful. I think China, in the Financial Times this morning, talking about them coming in and buying up a lot of different commodities for this energy transition that we need. So it's tense out there. I come back to the US though, John, if you don't mind, because you are there, you're boots on the ground for us, and talk about the way that companies. Not just as Dave said, not just the way that customers view this, but the way that companies view this. Sometimes the best form of defense is offense. So, what have you been doing? What will you do as a result of situations like this?
Well, I'll take two different stances here. Talk about utilities, what we're hearing from them, then I'll talk a little bit about UR Energy and what we're doing. But from our utility customers, even before Niger, we were hearing a lot of comments from them of diversification. We're looking at more North American, Australian exposure, less Kazakh, less Uzbek exposure, spread out that risk, because you never know what's going to happen globally. And they have to have fuel. That's non-negotiable. They have to have it. There is no replacement for uranium. They can't burn any other metal. So they have to have that fuel. And so I think this will really just enhance that. They'll look for more diversification, more stability, more stable countries. But from our perspective, with UR Energy, we like operating in the U.S. We love operating in Wyoming. No coups in Wyoming, no coups in the U.S. Transportation's not a problem. Every once in a while, the road gets shut because of a snowstorm, and then 2 days later, we're back delivering again. So we love the jurisdiction. It's a well-established regulatory regime. So we like being here. We like North America. Very often we get asked about M&A strategy. What are you thinking about when you look at acquisition? And number one on the list, if it's not a safe jurisdiction with a well-established regulatory regime, we're not interested in it. I often say if my guys have to carry an AK-47 to do exploration, it's off the list. And that's one of the reasons why we don't look in Africa. There's a high degree of risk, not in every country in Africa, but in many of the countries in Africa. So we really shy away from it. We really like North America. We like first world countries, safe, good jurisdictions. It's safe for us, and that makes it safe for our customers.
Yeah, I mean, the customers need fuel. And so in terms of what the companies have been doing, I mean, John's company, UR Energy, they're a great story. I mean, this is a company that's successfully operated a low-cost ISR operation in the United States. I mean, I just tick, right? We're aspiring to successfully operate a low-cost ISR operation in Canada. Both of our companies have been working during tough years to be able to be there for the customer when they need us. And John's on the is basically restarted, and we're on the cusp of wrapping up permitting and be able to start construction, because the need from the customers is not just in the near term. It extends for many years. And so our timelines, thanks to the work we've done over the last 5 years, which is when most people were doing nothing because they couldn't justify it, we're in the range of being able to produce in the 2027, 2028 range. And that's much closer than you think. Because if a company wasn't doing the kind of work John's done and UR Energy has done, then even a restart of a past producing operation doesn't happen overnight. And we're actually starting to get pretty close to a place of convergence between our new build timeline and restart if companies aren't actually investing the time and the capital to tangibly move their assets towards restart. Those take time. So, both of our companies have been pretty aggressive because I think, I don't want to speak for John, but I think it's because we could justify it, because our projects were good enough that before the market improved, we're able to invest in them and position them so that today and in the coming years, we can be a good supplier. I think the geopolitics has come to us a little bit in that, while we've advanced because we've got good projects, the market has also now said, oh my God, we need these good projects in good jurisdictions. And we're starting to really become premium products for the customer because we're advanced and we're in the right place with the right cost profiles. Again, just tick, tick, tick for the customers.
It's tick, tick, tick for the customers, but in the sense that you're ticking boxes, but it's also tick, tick, tick in terms of time, because you've got countries like Belgium, Poland, Sweden, most of Europe waking up to the fact that nuclear is an okay subject to talk about again. It's an okay subject to include in the green taxonomy of energy transition. So it's going to be very competitive out there. That's good news for you. It's good news for your shareholders. So as far as you're concerned, John, if we look at the way your messaging to shareholders, it would be what? How should they read the market at the moment? Because it's been a long time coming. Prices at what, 57.75 for a U308. You've got conversion at 40.75, and enrichment you have 6 at 188. So it's really starting to get there at the moment. So where should they be looking? What should they be thinking, John?
Yeah, it gets back to a couple of things. Looking at the global risk, geopolitics there, that could be what really moves the needle very quickly in the coming months, in the next year or two. And so it's hard to predict, but that could really drive prices. But importantly for us, because of that, companies have been coming to us and saying, hey, we want Lost Creek back up and running. We need access to that low cost, safe production. So they've been willing to sign up contracts with us at above spot and above long-term pricing. So we've enjoyed that. But I think beyond that, looking further out, years from now, basic supply and demand, as you've touched on, carbon-free energy, so many countries around the world are moving to that now, not just with renewables, but obviously with nuclear power. So many countries are building out. China is the gorilla in the room, 150 reactors in the next 15 years. That's an insane number, but they are meeting those goals. But so in the long run, when we get beyond geopolitics and any influence there, the demand is far outpacing the supply. And we expect to see continued increases in pricing going forward based on just fundamental supply and demand. So that's what we share with our shareholders, make them aware of that demand is there, the demand we expect to increase and the pricing to go with that. And as Dave indicated, Denison and us, we've got properties that can produce low cost, and that's what we're trying to do. We're trying to ramp up that production, move into more production over at Shirley Basin, try to get our production profile up over 2 million pounds a year. So that's what we share with the people that are part of our registry.
Well, and Matt, you know what I'm talking about a little bit is just the integrity of the companies too. The market for uranium has improved significantly, and so we've seen an influx of a number of new entrants. And at the end of the day, like, we all have some exposure to the uranium price, but we think the right and the most levered sort of investment are these companies that will successfully transition from developer to producer and re-rate, and whether that's from a past producer back to producer, same sort of re-rate. But there's quite a lot of things that have happened in the last few years around costs. And so, like, we've just put out a feasibility study for Phoenix and a cost update on a pre-feasibility study for Gryphon, which are both part of our Wheeler River property. And, it's surprising to me what information the investors have in the space to look at when they look at some of the companies out there. And we've just costed everything in 2023 universe, right? So we've got inflation, we've got real costs done by a third party in a technical report that'll be filed shortly. And so this is great evidence for an investor to say, okay, what is the basis for their low cost profile? We're very transparent about that. You know, John's got, and Your Energy has a recent operating track record with recent performance that they can turn to. It's when you look at the rest of the space and you start seeing people taking, you know, projects that haven't done anything in over a decade, or are referring to historical studies prepared over a decade ago. Like, to me, those are hallmarks of, look, these companies may have potential. It's not to say that they're scams or anything like that. They have potential, but know what the risk is. And some of us have really invested significant amounts of capital in terms of de-risking assets. And being able to be today in a place where our asset, in the case of John's, is turning on, and you've got a very reliable understanding how that's going to go because of their recent history. And in our case, really robust costing estimates, technical scrutiny done by a third party that gives us great confidence around our numbers. I think that's the kind of thing we're obviously promoting on the back of our study, is that, like, we have reserves that we've declared in accordance with 43-101. Reserves have a demonstrated economic viability. It's different than a resource. A resource is an estimate of pounds that, you know, are in the ground. What's the objective here? And the objective for our company is to take the pounds out of the ground, sell them, and convert them to cash. That's how we're going to make money in our company. To do that, you got to have the studies, you got to have the engineering plans, you got to have the details. And I just think investors right now, with all the sorts of things and the projects and the companies that are out there, they do have to start scrutinizing that stuff.
They do, they do, but they don't. And we've seen that, because I look at most people's charts since 2019, they just follow the market. Some companies have done nothing, and it follows the market. It's the same trend as yours. Now, obviously, you have certainly both of you.
Fullness of time, Matt.
Absolutely. Well, that's where I'm going to go. Don't worry, I'm going to go there. We'll let you shine. Don't you worry. Which is, you know, you do have to. It's a business. You're here to make money. You're here to make, you know, a lot of money. The biggest margins are in your costs and what you're selling it at. But right now, people look at the kind of uncovered demand charts and they go, "Oh, that's quite nice." There's not enough of this stuff. That usually has a very quick knock-on effect to the price at which utilities will sign long-term contracts, and even the spot price, which, you know, most people kind of look to as some sort of arbiter of future success in the sector. So those are the things which people look at today. So if we can just start down there, obviously uncovered demand at the moment is looking quite hairy from, you know, 2025 onwards. And everything we talked about today suggests that things like Niger have not helped. Things like Russia, Ukraine have definitely not helped. But there was already issues with developers, you know, professing X number of pounds in the ground, but the reality is they're a long ways away from getting it out of the ground. So, how do you see the kind of the Western market? I guess, resolving matters when it comes. Utilities have got to find these pounds. They've got to get this UF6. They've got to get the conversion. They've got to get access to all of the above pretty darn quickly. And it's like the sector's not really kind of coming together quickly enough to solve their imminent problems. I mean, am I wrong, David?
Well, no, Matt, you're right. That is a real risk. And maybe to connect the thoughts, I mean, it's not to say that the companies that haven't done these robust studies and that, you know, have old histories and stuff, it doesn't mean that they're not needed. It's more a question of, you know, how are people valuing these companies and things like that. That's more where I go to it. But yeah, like there's some interesting math on the uncovered demands. You know, and our math indicates that we need something like 5 or 6 McArthur Rivers to come to the market. I mean, McArthur River is the largest and highest grade uranium mine in the world. It's producing in the range of 10% of annual demands, or annual requirements. So that's not insignificant. I mean, to need 5 or 6 of those means that you will need many, and development projects for many years. And outside of, like, I think the rare minority of projects that were able to advance over the last 5 years, before the uranium price started to move up. Most projects have not been progressing positively. And there is a real risk that the supply side will struggle to actually meet the needs. So it is a problem, and a lot of those other projects will be needed. But we can I can tell you from our end, like, it's quite a lift to take a project at the stage of even a pre-feasibility study and bring it to a feasibility study, and now over the next few years to advance it to the point where we can start construction. Like, our team has grown. We've invested a lot of money in terms of building capabilities and being positioned to do that. It's a lift that I think a lot of companies might struggle with, and that ultimately is positive for the companies that succeed in doing it, but it's potentially quite a challenge from the supply side to actually get there, because we don't have 5 MacArthurs to just do 5 mines. We're going to probably need something like 20, right, to be able to compensate for that when you look at the scale of most of the projects.
Yeah, and just to add on to that, I think 2007 is a great analogy. What can the mining industry do when they have high prices? Look at 2007. We had spot prices then, 2007, 2008, over $100 a pound for a short term. And then you start looking, okay, how did the mining industry respond to that? And the answer is not very well. Very few mines came online. The ones that did are typically extremely small and not very economic, and they shut down very quickly when that price declined 2008, 2009, and then certainly post Fukushima. So I think it's an improper way to think about it, to say, oh, we're smarter now, we're going to be able to ramp up quicker, more mines will come online this time around. I don't think so. I think you still have a lot of the same players involved. A lot of the same assets are still involved. There have not been a lot of significant discoveries in that time frame. So I have a hard time distinguishing now from 2007 and the ability to ramp up. But further, so of Dave's point, a lot of the economic studies that have been done, a lot of the technical work that's been done, it's got to be done. But a lot of it is using some older numbers. A lot of it's on projects that have not been economic, maybe even since the 70s. And so you have to scratch your head and wonder, can these guys really come online? And more importantly, can they come online economically? Are they able to sign contracts and sustain production in the long run? I would say a fairly significant percentage won't be able to.
Well, not anytime soon, and certainly not anywhere near these prices. But you're right. I don't think we're any smarter than we were. There is the same old tired projects, and there are unfortunately some of the same old games being played. So let's focus on conservative, considered, intelligent approach to how you build companies and how you deliver those margins. So that's why you two are here. So I mean, Dave, that's it. You got to make money on this stuff, right? Okay, once the market momentum has subsided and people are meant to start delivering, and the rubber hits the road, you've got to make margins to be able to pay for stuff, because the cost of capital will kill most projects. You've been really quite cute over the past, in a good way, in the past 3-4 years, the way that you have brought money into the company with the different sorts of facilities, the different sort of buying of pounds, etc. Did you know then it would work, or did you hope it might be enough of a distraction to kind of bring some traction to the company? Why did you do those things when you did them?
Yeah, Matt, they're all deliberate and well thought out. Really assessing the cost of capital and developing structures that, in particular, our physical uranium purchase. I mean, we raised significant amount of capital via equity and then bought physical uranium. I mean, that was based on an appreciation that capital was present in the market and that our company would require significant capital to advance the project. And so that was a match, right? That capital is available and there's a capital need. What we didn't love was fixing the price that day and saying, well, today's the day we need to raise $100 million, because we have so much more de-risking and positive stuff to do with our company, where the value of our company should appreciate. And so that's what drove us to the concept of de-risking our balance sheet by raising the money, but deploying it into an asset that had a similar leverage to our commodity as our underlying development assets with the purchase of physical uranium. And so it was designed to give us financial stability so that we could advance the asset with great confidence over the next several years and give us a means to participate in our uranium market. And what it's become effectively is like a floating financing, because the proceeds from that financing change effectively every day when the uranium price changes. And so now it's not like we raised money at, say, $1.10 US, because the uranium price has actually nearly doubled from what when we issued that money. So, if we were to double our share price, and the math isn't exactly like that, but it would be more akin to raising money at, say, $2, because the value of what we brought back is now double from what we brought in when we initially raised that money. So, that was just putting pieces together and understanding that we would have significant capital needs. And one of the key ingredients when you have capital needs is the availability of capital. And so in 2021, when that capital was there, we didn't want to ignore that. That was really the focus on how we raised that money. But again, it's all part of having a longer term strategy around advancing our asset, knowing our future needs well in advance, and being deliberate, so that we knew that need was there, and that in 2021 it was an opportunity to actually address that need.
Right, and John, you've got a big cash balance, right? You've brought that together as well. Do things like Niger, and obviously the longer this Russia-Ukraine situation goes on, does that sort of change your kind of conservative approach to, your focus on Lost Creek and Shirley Basin, which we've talked about in the past? Do you look around and see some cash-constrained opportunities out there, which perhaps might be a little bit more aggressive, a little bit more ambitious than you say you were a year ago? Or is it kind of, no, we've got a plan, we'll stick to it now?
We're a pretty conservatively run company. We're very careful with the cash. It's a cardinal sin to dilute our shareholders, so we do our dead level best not to do that. And anytime we need to raise, we always try to find the cheapest capital that we possibly can. We're quite aggressive when it comes to that. But when we look at other companies and potential for growth and other assets, we typically don't play the pounds in the ground game. We play the pounds in the can game. And so there may be some opportunity here for acquisition of other assets, but they have to be quality assets, something that we believe that we can bring into production either now or in the near term and be profitable and technically sound and in good jurisdictions. But when it comes to deployment of capital, certainly we'll look at those things, but first and foremost is ramping up production at Lost Creek. That's well on its way. That gives us revenues. And then from those revenues, we don't have to go and tap the equity markets. Then if we want to make an acquisition, hopefully we can do some or all of that acquisition from revenues from production, from our low-cost mine at Lost Creek, and then from Shirley Basin. So we're going to continue to run fairly conservatively in that regard, and do our dead level best to get that production up, get line of sight on revenue, use that as our capital to advance the company through M&A or future production from our existing fleet.
And that's a reaction to obviously some of the mistakes you saw in the last cycle, where a lot of new entrants and with a lot of very average projects and a lot of debt and a lot of value destruction. Are you harking back to that, or is it something else?
It's a strategy we've had in our company since day one. And I think it's a reflection of our executive team, but also our directors. They have tremendous experience in the mining industry. We know the ups and downs. We believe the price of uranium is going to go up. Do we believe it'll perpetually stay up forever? No, it won't. There will be ups and there will be downs. And we're just trying to position ourselves to ride those waves over time.
See, Matt, John Cash and Your Energy, they're one of my favorite USISR stories for some of these reasons, because I think what I hear in John here is that he knows he's got a valuable asset. And so whenever you're doing M&A, we have the same problem. We get asked the question about M&A all the time. We care about NPVs rather than pounds in the ground. It's the same idea, pounds in the can. But when you have a valuable asset, it's sometimes difficult to pull off sort of the flashy M&A, because you have to realize that whenever you transact, you're going to be exchanging part of your company and your valuable asset in one form or another for another asset. And if that other asset doesn't bring you the same or greater value than what you've given up, then you've hurt your shareholders. You've diluted them. It's way easier to do M&A when you've got something that's of low value that may be overvalued in the market. It's much easier to do M&A. Like that's actually what you should be doing. So it's sort of a hallmark where you've got people who are, unless you have a synergy, a special synergy or something like that, like if you're just acquiring things to acquire things, it might call into question, the value you see of your own assets, because you're giving up part of your company to get these other assets.
Yeah, you've hit the nail right on the head, Dave.
Yeah,
we're not talking about any companies in particular here, just in general.
I think you could apply that across the mining industry. Like that is the nature of it. Is that if you have a valuable asset, sometimes it's difficult to actually pull off M&A if you don't actually have a fundamental synergy.
Yeah, and I think we've seen a lot of M&A with companies that don't actually have anything. I'm not talking about in the uranium space. I'm talking more broadly in mining, as you are, where the merger of two equals equally bad have been happening. So look, the other thing where I was wanting to go with you, David, was with regards to when you sort of step back and say, look where we were 4 years ago, look where we are today, and we look at the uranium space. It's still a tiny little pimple within the natural resources space, let alone the entire investing universe out there. It feels like, and I referenced it earlier about in terms of like the market needing to come together and have a sort of more coherent approach to how it supplies the market. We've seen Cameco make a few moves. And, in terms of this joined up thinking, if you've got utilities, they want to, potentially, I think some have said, we want to be able to have like, a one-stop shop where we can go to one provider for all of our needs, job done. Whereas at the moment it's, fragmented, say the least. Do you see any opportunities given this new environment where they've got this North American energy transition happening, money being made available for critical metals and critical minerals, receiving a little bit more of a positive, positive attitude in the market as a whole? Capital could be available for some big ideas where you can provide a one-stop shop. Do you see Denison or any other players in the market perhaps wanting to kind of step into that gap and maybe open the game somewhat?
I think there's a real tangible barrier to that happening for most companies. I mean, I think Cameco has got an excellent story, and they've done really well with this Westinghouse transaction, and I'm really hopeful for them that all closes timely because the market loves it, and they've been making it work really well for them in terms of commercially accessing different customers by leveraging the relationship with Westinghouse and the whole fuel cycle. But it really is a significant barrier for the other players and other companies in the sector to be able to try to replicate something like that. I think, though, there is quite a lot of room for the developers and the other smaller scale miners and producers to meet a different need that the utilities have. So yes, some of the utilities like the idea of I can go and procure everything through Cameco. One of the anxieties some of the utilities have, though, is that they are procuring everything through Cameco. In that, we talk about diversity of supply from a geographic or geopolitical standpoint. There's also growing anxiety around concentrating contracts with just one commercial player. And so many of the discussions we're having are people saying, look, we would really like for Denison to be successful to build a new project, offer low-cost supply of uranium from the Athabasca Basin so that we have more than one option in the Athabasca Basin. And, I think there will always be a group. Every utility behaves a little differently, Matt. That's how it goes. Like some of them will buy EUP. That's what they want. They don't want to manage fuel cycles. Other say, look, it's our responsibility to manage the fuel cycle. We want to buy U3O8. That's never going to change. There will be a differing strategies out there. But those that are buying U3O8 are definitely saying, I can't, it's not in their benefit. It's not to their benefit to only be able to buy U3O8 from Cameco. and they would definitely like to see other producers offer supply in Canada. I think they would be happy to have supply from the United States and Australia, but there is a point where I think Cameco is almost saturated what they can offer on the U3O8 side. They've already gone out. They've already signed an enormous number of contracts. The utilities have had to almost be takers of some of those contracts because there aren't very many other options. The utilities definitely are keen to see other sources of supply outside of Cameco.
Well, definitely. Look, I'm not advocating a monopoly. I'm advocating competition, but vertically integrated competition across the board for the West. Look, I'm just got a conscious. Maybe a few last words from each of you about your respective companies, and maybe just a thought from each of you about how investors see the runway for the next certainly till the end of the year. Some big conferences coming up, September, October, traditionally being points at which utilities make decisions. But as price grinds slowly, accretively towards, a near incentive price for a lot more developers, it's like walking over broken glass at the moment. What do we think about the next 6 months? I mean, John, I'll start with you and maybe just finish off with a few reasons for investors to be thinking about investing in UR Energy as well.
Yeah, absolutely. And first off, really interested to see how the Phoenix project comes with Denison. That's of incredible interest to us as they apply in situ. We've been watching that closely, and we're really excited about that. We think they've been ticking all the boxes, to go back to that analogy, as they've done different research on it, sets of research projects on it. So we'll be watching you, Dave, to see how that comes out. And we think you're going to do really well. And so we're excited about that. But UR Energy, we consider ourselves a value play in the space. We're not the biggest company, but we have very low cost of production, and we're ramping that production up at Lost Creek. We're engaged in engineering right now for our Shirley Basin project, hoping to make a decision on whether to ramp that up or not before the end of the year. We'll see where the market goes. More importantly, we'll see where contracting goes. So we're well cashed up. The small amount of debt that we have remaining with the state of Wyoming, we'll have it paid off in just about a year now. And so that's getting to be a very low risk for us and easily managed. So we're excited about the future. Things are going really well at the mine site. And we encourage the viewers here to check out UR Energy. Right, a great story. We try to keep it a very clean story. Minimal debt, low royalties, low technical risk, low jurisdictional risk. And so that's the story that we're trying to maintain.
Yeah, and Matt, I guess on our side, look, we've had a very eventful last few years advancing Phoenix through technical de-risking. And just earlier this summer, we announced the results of our feasibility study for Phoenix, as well as a PFS update for the Gryphon deposit. And as John notes, and appreciate John's confidence and following along with us, Phoenix really is now positioned to be the first ISR uranium mine in the Athabasca Basin, and to offer costs that compete with the best in the world, and and as low cost as some of the best assets in Kazakhstan. So it's a hugely exciting time for our company, having come through the feasibility study, confirmed excellent results, all third-party independent QP'd, and now transitioning to the detailed design and engineering phase, and delivering on the final stages of the permitting process. And so you certainly can follow along for progress on the project development front for Phoenix as we work towards construction decision in around that 2025 timeline, but also our other assets. With our success at Phoenix, it's given us great confidence to move forward. And so we are active in the field at Waterbury Lake right now, working on the THT deposit, which is also an ISR potential project. And we're working together with Orano, which is, a French state-owned giant in our industry. And we're operating a project called Midwest with them. We own 25%. They're a majority owner, and we've got a program on this year to study Midwest as an ISR project in the Athabasca Basin. And we don't have any economics out on that, but there is the potential for us to deliver a PEA by the end of the year or early into next year, following on a concept study that we completed late last year, beginning of this year. And it really has some exciting potential as an ISR project. So we do have multiple assets pushing forward at a very exciting time, and on the cusp of becoming that next large-scale, low-cost producer in the Athabasca Basin.
Okay, gentlemen, John Cash, Your Energy, David Cates of Denison Mines, two companies we like. Certainly the Crux Index scores them highly on a fundamentals basis, and growth ahead for both of them. So do take a look at those, folks. And guys, thanks very much for today.
Thank you, Matt.
Thanks, Matt. Thanks, John.